Hello, I'm Greg Bonnell. Welcome to TD Active Trader Live, brought to you by TD Direct Investing. This is your educational one-stop shop for in-depth market analysis and investment insights to help boost your trading potential. Coming up, Wall Street shaking off the U.S. government shutdown. So, what's behind the resilience? Wellington-Altus Chief Market Strategist Jim Thorne joins us in just a few minutes' time to share his outlook, including his bold call for the S&P 500. Plus, we're taking a closer look at a Canadian equities ETF that has surged 25% this year. We're going to break down what the technicals are telling us. That's all ahead. You're watching TD Active Trader Live. Half an hour into the trading day, let's get you caught up on the market action. The S&P 500 mostly looking past the U.S. government shutdown. Discussions I've had on some of our other shows indicate that, it's about duration here. You get a couple days of a shutdown and then you get past it all. Well, it doesn't mean all that much for corporate earnings going forward. It will be if it's prolonged, maybe a rethink. But right now the market's thinking we can look past this for now. I want to jump into the heat map. I want to see what's actually moving today on the board. You can see you got a bit of modest strength in some of the tech names. NVIDIA up about 1%, Google, Meta, and Apple, and Broadcom all in positive territory. Not so much for some of the financial services stocks like a JPM, a Visa, or Morgan Stanley, but they're only modestly lower. We got a big deal today involving Occidental Petroleum. Berkshire Hathaway has reached a deal to buy Oxy's chem unit. That would be a petrochemical unit, I should call it, OxyChem, for $9.7 billion in cash. This is Berkshire's largest deal since 2022, when they went out and spent almost $12 billion on an insurer. And Occidental, for its part, saying this money, debt reduction, is going to enable them to start rebuying some of their stock. So an interesting move indeed. It's not really moving the shares of either company all that much. It just tells you how big these entities are when a almost $10 billion deal doesn't move the needle all that much, but it is interesting when you're talking about Warren Buffett's empire. Western Digital, want to check in on that, a bit of a pop in the shares there. They popped yesterday as well. Some reports out there that the CEO is saying they plan on investing $1 billion or more in Japan over the next half decade. So we did get the pop in the shares, but now that we're open, I'm just looking at the corner of the screen there, pulling a little bit back from that excitement that it first had over all this. And that's your market update. All right, joining me now from London, Ontario is my colleague Hiran Amin from our direct investing team, and our guest of the show, Jim Thorne, Chief Market Strategist at Wellington-Altus Private Wealth. Gentlemen, thanks for joining us.
My pleasure.
It's great to have these guys. Yeah, a reminder before we jump into our viewers, the views and the forecasts expressed are solely those of Jim and his team at Wellington-Altus, and it is based on their research. Jim, let's dig into this shutdown. We're in day 2 right now. The markets seem to be looking past it. We have resilience. We have markets that keep making record highs. How do you read the situation? What's happening with the mechanics of the markets?
I think the market is finally coming to terms with the fact that President Trump's strategy and economic strategy is focused on deficit reduction. And he's not going to spend willy-nilly, which was the consensus view coming into the election last year. So we think it's highly positive. We're entering into a brand new era where supply-side economics is taking hold in the United States. Not so much here in Canada, where the Keynesians are still running wild. But we look at it as a very constructive period of time. And we suggest risk on. So we think you look through this, they're going to, if they don't settle, they're going to get rid of a lot of fat in Washington, D.C. And guys, I lived there for 15 years. 25% of GDP goes through Washington, D.C. There's a lot of fat to be cut. So I look at this positively as the deficit in the United States is going to come down, and that people, the bond vigilantes in the credit markets, are going to finally come to terms with the fact that Trump's policies are focused on deficit reduction. So I think it's hugely positive.
All right, so positive in the equity markets hanging in. That said, I also understand you're recommending exposure to gold and Bitcoin. What's the optimal allocation here if you're thinking? And explain it to me too, right? Gold, traditionally the safe haven. Bitcoin, you're starting to see it as a digital gold play?
Yeah, well, I'm an old CIO, institutional side, so I look at the index, right? And so first off, look, the thing about macro is that, you know, the themes are there to be had. It's the timing that's hard. So throughout my career, it's been fiat currencies unsustainable, too much debt, okay? Well, that has now kicked in, right? So for 3 to 4 years at Wellington, I have been saying have a significant portion in gold. Gold is about 10% of the TSX, right? So if you're talking about your benchmark, your market weight is 10%, right? That's one, right? And two, with Bitcoin, is its perfect digital scarcity. And so, look, I would suggest to you that we are in the early days of innovation coming into the financial markets. President Trump is the crypto president. Don't overthink this. So I think in your portfolio, you've got to think about a weighting of around between 10 to 13 to 10 to 12% of Bitcoin and gold. And then what I would say to you is, if we're talking about traders, is look, you sell parabolic moves. So I am dealing with calls all day long now, basically guys wanting to buy Agnico Eagle at 225 after a massive parabolic move. Well, look, if we're listening to talking to traders, you sell parabolic moves. Where is the chart pattern that you want to be looking at? You want to be looking at Bitcoin that has gone through this long, frustrating consolidation pattern that if it breaks out, it projects to 170 to 200. So we're in a bullish market. It's rotate your capital, sell parabolic moves, and put it back into those areas that are basically just finishing off a very frustrating consolidation period.
Jim, I'm going to just jump in. We're going to bring it back to the equities. You know, there's an old adage that I'm going to bring up first is that bull markets don't die of old age. And in some versions of it said it's killed by the Fed. Now, you've said the Fed has overplayed its hand and needs to be put into the proverbial penalty box. So just explain that to me, what that means. And do you expect rate cuts sooner than the markets are pricing in? And what would that also mean for risk on assets?
So I would expect, I think we're going to go, the states are going to go to 275, the Fed. And in Canada, we're going to go close to 1%. What I mean by overplaying its hand is, look, I'm going to get a little bit esoteric here, right? There is a decision by the Supreme Court of the United States last year called the Chevron decision, which basically what that did was it put power back into the White House or the executive branch to question gray areas where the legislative branch overstepped their bounds. Okay? And so what the Supreme Court said was, we are willing to rule on this. They didn't do it for 40 years. What does that mean? The Fed is basically not more important than the U.S. Constitution. The Fed has mission creep, the movement into climate change, the movement into diversity, although very virtuous programs, I get it. That is not what they're supposed to do. So with the Cook situation, what they have done, and I'm not the only one that's saying this, is look, Trump is taking this to the Supreme Court. And the Fed needs to get back to just focusing on independent monetary policy, which I do not think has happened. Let me share a view with you back in 2002 when I was down in the States, and a very high-profile gentleman from Wall Street came into my office, and he was the type of person that would get a quarterly meeting with Alan Greenspan. And he had just come back from his first meeting with Ben Bernanke. And I said, well, what do you think? And he goes, he's going to turn this thing into a Keynesian academic institution. That's what the Fed is right now. If you look at market-based data, let's look at Lenar's numbers. Okay, Lenar's numbers, 9% decline in new home prices. Plug that into PCE or CPI, and you are in CPI, you are negative, and PCE, you're at 0.5. So the question you have to bake yourself is, with 900 or 800 PhDs, Why aren't they doing the back of the envelope? And why are they hanging on to owner's equivalent rent that everybody knows is lagged by 2 years? So the point is, everybody knows it now. Everybody's talking about it now. So their reputation is toast. So what I would suggest is going to happen is the Fed is going to go back. No more of this QE and QT. They're going to have a very narrow mandate. And then the other thing that's going to happen with the deregulation of banks is credit creation is going to start to go back to Wall Street. We're going to go back to pre-Dodd-Frank, right? And what we're going to do is the banks are now going to be able to trade on their own behalf. As opposed to having all that money sit at the Fed, they are now going to be able to have prop desks, and they're going to be making markets in treasuries, for example. So what you do is you get the power slowly moving back to Wall Street and the private sector. Yes, the Fed will have independent monetary policy, but it will not have its claws, so to speak, into the business cycle. The business cycle goes back to the private sector.
Okay. I like that a lot, Jim. And let's talk about the business cycle now, and specifically about the S&P 500. We just saw it hit a record, just past 6,700 for the first time. You wrote in one of your notes back in August that you see the S&P going up to as high as 7,500 by spring 2026 is what, if I got it right, that you called it. Now, given that we're having a U.S. fiscal reset, recent policy moves, and the little bit of volatility that's starting to froth, what factors would make this realistic, and how should investors be positioning for it?
Well, it's not about, it's, you know, you got to be a data hog like me, right? So what was unique about the Liberation Day, right? So every year, as traders or investors, we should expect an 8% correction. And that's normal, natural, and healthy, and it could happen for whatever reason. It's the 20% corrections you got to pay attention to. And when you have a 20% correction in the first 2 quarters of the year, it is a very, very unique environment. Add to that you never get 2 successive 20% corrections in a row unless you have a recession. So I'm not saying I'm not in the recession camp, I'm in the slow growth camp. Okay, that's fine. So what does that mean? That means that the 4-year cycle has been reset by President Trump. And if you go back and you look at history of what happens after a 20% correction and what happens after 12 months out, you get 74 to 75. April was when it happened. There's the spring. And then you go further. What does that also mean? And so you're thinking about, guys, this is a year like 2003 and 2009, where we've got very unique seasonality. So what just happened? The usual seasonal weakness in August and September no longer existed. It didn't happen, right? That is exactly what happened in 03 and 09. What also happens if we're going to use that analog? Well, typically, you know, if you go back 20, 15, 20 years, fourth quarter returns are around 4 to 5%. You're getting into the seasonally strong part of the year. But what happened in 03 and 09, or years like that, is you get a rate of return in the fourth quarter between 8 to 12%. Why? Because everybody's missed the trade. Everybody's catching up. Okay? What's happening as we were talking before we come on? Now everybody's saying 7,000. Everybody's, of course it's 7,000, right? Where were these guys in April? Right? So now you've got guys going to play catch up right now because, oh my God, at the end of the year, I got to do client reviews. You know what I mean? And so valuation gets thrown out the window, and we have a very big bull run into the end of the year. So my view is, as I kept saying, I'm 7,000, I'm low, I'm not changing it, right? I got the direction right. You know, when we get between, let's say, the end of the year and April, when the S&P gets about to 74, right, I would suggest you raise cash because I think what's going to happen is we're going to have a normal, natural, and healthy correction, right? Where you can go off, make some money. And then I think, we're going to have a very bullish rally into the midterms, and 8,000 by the end of 26 is something that everybody should be putting on their bingo card.
All right, so that's a nice breakdown of your call for the American markets. What about Canada? We've been on a pretty good run here with the TSX. I think you referred to it as a relief rally and a honeymoon trade. Where can the Canadian markets go from here? Do we have more steam?
Well, two things, right? So in a global, we're outside of Canada, right? We're in the States, we're in the city of London, and we're running a global macro fund. One of the easiest trades to do is to find a geographic area that is going through a major political election, and the socialists are being thrown out, and somebody's coming in with a moderate or center economic platform, right? And so if you looked at Canada, in this election, it was Trudeau and Friedland, extreme progressive left policies being kicked out. And Carney was basically saying he was not Justin Trudeau. So the easy trade is, or the honeymoon trade is you buy that geographic area, whether it's Greece, Spain, Germany, Argentina, what have you. You get a 6-month rally, and it's like where we are right now. Okay, Mr. Carney, okay, Mr. Prime Minister, where are your policies to make Canada an energy superpower, right? Because you certainly right now sound like Justin Trudeau, right? So that's the first step. He needs to pivot, and if he doesn't, global capital isn't going to put up with it, okay? First off, right? Canada is 2 to 3% of a global allocation. With global investors are not going to put up with another 4 more years of Justin Trudeau. Okay, that's one. And then you go through and let's deconstruct the TSX. If you take gold out of the TSX, it is a normal year, right? So if you got to beat the TSX, you got to have 20% gold. So go ahead and deconstruct the performance of the TSX relative to the S&P 500. Okay, so take out 10% gold and see what it does, right? Or add 10% gold to your S&P allocation or your NASDAQ 100 allocation and do the evaluation. The move of the TSX is all gold, right? So let's think about this. Like we were talking before, Nico Eagle, I love it. I've been talking about gold forever. It doesn't matter whether I love it or not. If you're a trader, you sell parabolic moves. Okay. So gold, and look, I got a 5,000 target on gold. And I got a 5,000 target on gold 4 years ago before all the cool kids start talking about it, okay? Before all the PowerPoint crowd came in, okay? But trees don't grow to the sky. You could, just like NVIDIA, you could have a period of consolidation, frustration, right? Gold in the fourth quarter, on average, going back 20 years, 1%. It peaks here, it bottoms in November, and then it rallies into the Golden Weekend, or the Golden Week in China and in India wedding season. Okay, Bitcoin going back averages, depending on whether you do a 10-year or a 13-year, averages between 60 to 90% in the fourth quarter. Those are numbers. And you've got Bitcoin coming out of a massive, frustrating consolidation phase. As a trader, I know what I would do in the pair trade. I love gold, but I would trade some gold. I would sell some of these high-flying stocks. And guys, look at the juniors. When you start to see juniors come out with drill reports and they go up from 50 cents to $5 and they do a secondary, come on. Hey, can you see over this shoulder right here? I got a share right there in orange, okay? Guys, that's Bre-X. Okay, guys? That's Bre-X. I've been around for a long time. Okay, when you got, I've lived through this. So for the for the longevity of the cycle. And I'm bullish on gold because people are fed up with fiat currency and excessive levels of debt. Okay, is that fair? But still, parabolic moves have to be sold, and there needs to be a period of digestion. So that's why I think the TSX has done so well this year, confluence of two events. And I would suggest that the TSX will do okay, right? Will do okay. I just think the massive move, as I say, you got guys wanting to buy Nico at, I'm giving you Canadian prices, between 225 and 230. Guys, you've missed the trade. Like, you're buying high. Like, come on.
Jim, let's actually talk on that point, because you mentioned this, and we know the Canadian equities have actually outperformed the U.S. equities thus far this year. What do you expect that to continue into the next couple of quarters, given where you see gold still going, or is it going to be underperforming and U.S. is going to catch up?
I think Canada. So what I would do is go take a 2-year view. Everybody that's talking to you about Europe and everything like that, everybody forgets the massive historic outperformance in the first 2 quarters of last year in the Mag 7 in the United States. So let's take a 2-year view, and everything is normal, right? So when a reflation cycle happens, what will happen is you will get all risk assets going up. As traders, what you want to do is you want to basically sell the overextended and buy the stuff that's got good fundamental support. I think the NASDAQ 100, I think we're at the very beginning of a major CapEx super cycle in the United States because of AI. Trump and his big, beautiful bill has made CapEx 100% tax deductible. We need between 95 and 100 gigawatts of power. A nuclear reactor is 1.2 gigawatts of power. Okay, so are we going to use natural gas turbines? That's GE, Verona, Siemens, and Mitsubishi. I don't hear of any Canadian names in that, guys. Is everybody going to pile into Cameco or Denison? Right? So I think Canada's going to be fine. But this the Canadians, we got to splash ourselves with some water, with some reality. What do we got? We have an unbalanced economy, right? That is dependent on real estate. We got a Bank of Canada that basically is following in the Fed's footprint and flying the plane into the side of the mountain, right? At least they took it down to 275. Unemployment is 7%. Unemployment in Toronto is close to 10%. Productivity growth is non-existent, right? We don't have an economy to domestically support autos. We're closing down another plant. Like, guys, we're going through a major structural adjustment. If you're going to buy the TSX, tell me why. Fundamentally, are we going to all pile into? I love banks, and the banks are going to be fine. But that period of catch up is over, right? When will the TSX really kick in? I think the question is, it's really predicated on how much further do you really think gold can go? Is it going to go to 4? Because it looks like it's going to go to 4,000, and then it's going to have the blow off top, right? I mean, look at the number of secondaries and junior mining stocks that's being printed up here. Come on, guys. Bre-X, okay? Right? So, to me, Bitcoin is the play now. At least within the United States, you have earnings, right? Bottom up earnings, right? Is targeting 74. So I can give you 74 next year in the S&P just on earnings.
Jim,
okay?
always
you get
always
the Fed
ensure.
cutting, you get multiple expansion. The last thing I'm going to say about bubble is this. A bull market does not end on valuation. A bull market ends when credit or liquidity is turned off. And we're in a period of time where the Fed and the Bank of Canada are going to continue to cut rates. So I love risk assets. My big statement to everybody is no cash. If your jam is the TSX, God bless you, it will be fine. But the period of extreme outperformance because of Carney and gold, I suggest is over.
Jim, always intriguing thoughts. Always a pleasure to have a conversation with you. I hope you'll come back on the show and join us again.
Be safe, guys. Thanks for having me.
That was Jim Thorne, Chief Market Strategist at Wellington-Altus Private Wealth. And just a reminder to our viewers that the securities and strategies discussed on our show are for educational purposes only, should not be considered investment advice or buy, sell, or hold recommendations. Herein, Jim gave us a lot to chew on there. I always love listening to him talk about the markets and his strategy there. So this idea, the thing that so much of it struck me, but I'm just thinking about the S&P 500 call into the spring, that there's further room to run. But if you believe in the TSX, you got to believe in gold, and perhaps that trade has been played out.
Exactly, Greg. We're actually going to talk about this. Is going to be a nice segue into actually us breaking that down. But yeah, you have to think about what our economy really is reliant on. It's a lot of miners. It's a lot of raw materials, resources. Energy is a big product of that. And so what's really been blowing up the market so far, as Jim alluded to, was gold has just been pulling it up. We covered it in our last week's episode. We talked about the divergence of the miners between gold and gold kind of catching up there. But how much of that has already been played out? So that's interesting that he mentioned that. And then the other thing was Bitcoin. He's talking about, and there's more and more, Vanguard had come out earlier in the year saying that they believe that a part of a diversified portfolio's allocation is having also crypto in the form of Bitcoin being allocated to it, which, as you alluded to, Greg, is the new, or consider the digital gold of it as well there, just to hedge it as we get to these sort of parabolic moves on the markets here.
Yeah, one of the big questions people have had for, is it risk asset? Is it digital gold? Is it both? But we're gonna find out. If you at home have a question for our guests or our team, here's how you can get in touch with us. Just email td.activetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. It's going to take you to our TD Active Trader Live website, where you can try out the TD Active Trader platform risk-free. You just open a practice account, you click on Try TD Active Trader, that button right there. Then when you're ready to switch to a live account, you simply export your workspace and you start trading for real. Now for a technical take on what's happening in the markets herein. What are you focused on? I think we got a Canadian flavor off the top.
Yeah, we wanted to touch on what we just had our conversation about. So since we're using the Active Trader platform, the ticker I have what's up on the screen is going to be EWC. This is the iShares MSCI Canada Index. Now, it basically tracks the performance of the MSCI Canada Capped Index, giving exposure to large and mid-cap Canadian equities. Of course, we know the majority or the heavy concentration is going to be in your financials, materials, and technology, really representative essentially of what the TSX is. Now, what you've seen in the returns, and I'm just going to be pulling up the chart over here. We've seen just coming off of, and I'm going to go back to like December, we were in this sort of downward slump for a big period of time, almost up until Liberation Day. Of course, that was the big catalyst where we had this V-shaped correction that happened and we started this new bullish channel here. Now, remember, our returns, our TSX returns, are heavily tied to commodity cycles, interest rates, global demand trends, and resource prices. Now, we've seen this big run, and this is attributed to what Jim had alluded to, was gold makes up roughly about 10% of the composition of our markets, Canadian markets, and that's been a real, been pulling up the performance that we've seen over here. Now, one thing I am cautious about is, just being cautious as we get to these tops. Now, we can see it's respected this channel for, this entire time so far. Anytime it gets to the upper bound, we see a rejection. It did break over here, tag this, which became its all-time high at $51. Then it did peel off of that and is now testing that upper bound once again there until we run into resistance. So the big break will be, it has to break above the 51, continue in this channel, and retest that 51. It hasn't done that so far. We've just seen a break of the upper bound, but it hasn't been able to break that threshold. Now, the other thing I've also mapped out over here, Greg, is just the S&P 500's performance, and I've just got it mapped in this red line chart over here that we see. And you can see that we saw this divergence take place sort of in the first half of the first quarter of the year, and it's kind of been lagging so far and just been underperforming, just sitting below where the 150-day moving average is right now. Now, so far with the momentum, it's kind of still holding in shape, but we are seeing now a little bit of divergence forming, and what this really means is that the RSI is starting to look like it's trending down, as well as the MACD is trending down, which means we're probably getting towards the top where we might see a bit of a reset and maybe possibly testing the lower bounds on this ticker here going into probably the end of the year here.
All right, great work up on that ETF and the Canadian market. You've got Peabody Energy on your radar too. What's going on with this one? What's intriguing?
Yeah, let's talk about energy. You know, that seems to be the theme of the jour. Of course, Peabody Energy is one of the world's largest private sector coal producers. It operates 17 mines across the United States and Australia, and it supplies thermal coal, which is used to generate electricity, and metallurgical coal, which is used to make steel. Now, the reason we want to focus on this is because they're doubling down their U.S. thermal coal business just as power demand from data centers is hitting record highs, making its Powder River Basin assets newly strategic there. Now, this is just on the fact that we just talked about this. Data centers, specifically AI and hyperscalers, they require energy in the gigawatts, like 100 gigawatts, and most of these, like the newer sort of fuel cells or small modular nuclear reactors, they're only powering about 1 to 2. So traditionally, you're still going to have a base power load that's required on a 24/7 basis, and that's where they're really doubling down their efforts. So looking at the charts with what's happening with BTU, we've seen it come off this big slump here. It's got its, again, like many other, after Liberation Day, we started seeing it pick up, but it remained range bound. You can see it was failing to break this key support, which was just sitting just above the $15 support zone that we have, until just in the midsummer where we did see a breakout finally happen. Part of that breakout also meant it formed a wedge between these two support areas. Now the 15, which is a support, 18 was a resistance. It formed this double bottom pattern, which is basically a continuation pattern showing us that we're going to see a correction, a rally to the upside. And we did see it kind of break, and then look at this pattern. I'm just going to try and zoom in for everyone a little bit over here. We zoomed in a bit more than I wanted to, but coming back over here, we've got this sharp bullish rally now, and you can see I've just marked it over here, 8 consecutive green day streaks, and it's been setting newer highs. Each close has been consecutively higher. Now, until we reach this resistance point, I've marked this at 28, and today the price is just broken above the resistance, but we're sitting right on that $28 level now. Now, what we want to see is we want to see a close above that 28, and we want to see another confirmation when making another high beyond today's high that it's made, to see that this trend is still going to be valid, inching towards its 3-year resistance, which is going to be that $33 level. So this is one to keep an eye out. You know, traditional coal is still probably not quite dead yet, given the data center electricity demands that are out there.
All right, so interesting work on the charts there. Now you're going to walk us through a couple ways that someone could possibly trade Peabody Energy. But before you get started on that here, I just want to remind our viewers that options trading carries high risk, may not suit all investors. Significant losses are possible, so it's important to assess your own risk tolerance. Make sure you do your own due diligence before engaging in trading. Walk us through it.
Yeah, let's talk about it. Let's talk about the bullish trade first, Greg. I've got this one pulled up on the charts, looking at the options here on BTU. Now, this is one thing I've marked out. We did see in the marked levels, we've got 33 as a 3-year resistance. It's sitting at the $28 level right now. So if it can break, if it can kind of break and test there, then we could see a next leg up there. Now, Peabody Energy is coming into earnings at the end of this month, so October 30th is when they have earnings. So one way, if you are bullish and you are expecting that move up, we could do a bullish calendar spread strategy. Now, what this essentially is, you can see this trade essentially means we're going to be trading with the same strike price as the $30 in this case. Now, the reason why it's all in the name, the calendar spread, is that we're going to be choosing different time cycles over here. Now, overall, we still want to give we have a bullish view, so we're looking to go out to the January cycle, the 16 Jan. It's about 107 days till expiry, buying a call there, and then selling a front month, which will be from the November cycle, the same strike. So we're buying the $30 strike for January, selling the $30 strike for November. Now, the reason we want to do this is A, it is going to reduce our overall debit or costs to be able to take that bullish view on. But B, we also, considering that we're going to running into earnings, we'll see a little bit of a volatility tick up, and then just coming out of earnings, we should see a volatility crush happen. So this should support us, and we should see that price retrace down coming, or volatility come down, I should say, which would be aiding the trade. And then hopefully if it marches on its way to that $33, then we could see a little bit of profit generated as it gets to that price. And anything beyond that is obviously going to be a bonus there for us. This trade will be usually cost a premium. Right now it's based on what we were looking at, it's trading at about like $2 and change. And so the upside on this trade would be essentially our break even is going to be at least the $32, and if anything beyond that is going to be bonus for us and more profit there.
All right, we always have to talk about the risks in that trade.
The risk is, of course, if the trade doesn't go our way, if Peabody remains below 30, we just stand to lose what debit we're paying. In this case, if it's going to be the $2 premium that you're going to go in for, that's what you stand to lose on a single contract. That represents $200.
All right, so the other side, of course, if you're not the bull, then you're the bear. How could you possibly play that?
All right, so if you're bearish, I've got this mocked up a little bit here. Now, what I wanted to do is I wanted to go up to the weekly chart over here and switch that and just point out a few things here. So on the weekly chart, we're going back just into 2024 here. We saw that the Peabody tends to peak at this 28 level, this key resistance level. So it's peaked there once before. It's peaking there right now, and it retraced before. Now, if history is any indication, of course, we might see some profit taking at these levels to the downside. So one way you could play it as a bearish move would be a bear put spread. So it's a directional trade to the downside. What we're looking to do here is go out to the 21st of November cycle. So it's roughly about, given about 45 to 50 days there. We'd be looking to buy the at-the-money put option, which is currently at the $28 strike, and we'd be looking to sell the $24 strike further down for the same expiry date there. Now, this is an anticipation that we see this key level being sort of a support that's previously been held. So if there is going to be a downside move, it could possibly retest that. 24 is conservative, but it could go down to a 20. Now, it is a $4 wide spread. This is really dependent on the trader and what your risk appetite is and what you expect the move to be. In this case, we're going to be playing it a little bit more conservative to just see if we can get down to the $24 level. This trade is currently, the premium is roughly about $1.70. So, Greg, we know we like talking about risk, so that's what we stand to lose. It's $1.70, and this happens in case it doesn't actually end up going down, and in fact makes the move to the bullish on the upside there. Now, the max profit, of course, would be if it goes down all the way to 24. In that case, it's going to be the spread, which is $4, which is what the width of the spread is, minus what we paid, which is $1.70, which means about $2.30 is up for profits if it does in fact get to that price.
I like how you put that little information box in there about the break even, the max profit, the max loss. You're making it really clear for me. I think for the audience too.
Yeah, we're going to try something new there. So anything to help there, Greg.
Great stuff as always here. And another great show under our belts. That's the show for this week. As always, investors should perform their own due diligence before engaging in trading. Thanks for watching.